So now we are going to continue on with the recognition and disclosure issues related to Bradford Company's bond. We've just computed the present value and determined that the present value was that $70,824,063. And so now we are going to deal with the recognition issues. The first step is what happens on January 1st when the bonds are actually issued. So on January 1st, 2013, we just determined that the amount of cash that's going to be collected is the $70,824,000 and some odd dollars. The bond payable, the face amount of the bond, is that $80 million. And so cash is going to get debited for the $70 million some odd dollars that we actually collect. Bonds payable, the liability or obligation, is going to get credited for $80 million. That obviously is not the full journal entry because every journal entry has to have equal debits and credits. So the difference between the amount of cash collected and the face amount of the bond has to go into either what's called a discount on bonds payable or premium on bonds payable. In this particular case, the bonds are being issued at a discount for less than face value, and so we need a compensating debit of $9,175,937 to recognize the dollar amount of the discount that was generated as a result of this bond issue. That discount on bonds payable is what's known as a Contra liability account. It will be presented on the balance sheet associated with the bonds payable. It's not an asset account or a separate liability account. It's what's known as a Contra liability account. So it is a liability account directly associated with bonds payable, but it has a balance that is contrary to the typical balance that we would expect of a liability. You are already familiar with a variety of Contra accounts. For example, accumulated depreciation is a Contra asset account. Accumulated depreciation is associated with specific depreciable assets. It's presented on the face of the balance sheet as a part of those fixed assets, typically as a net amount. So the historical cost of the asset minus its accumulated depreciation is the net amount that would appear on the balance sheet. Same thing happens here with bonds payable. Bonds payable, the face amount is $80 million, but it will be reduced by the discount on bonds payable when we go to presenting it on the body of the financial statements. So that's what happens on January 1st of 2013. The next thing that happens is June 30th, our first interest payment. And so we need to determine what happens with our first interest payment. So June 30th, we know a couple of things. We know, first of all, that the amount of cash that's going to be paid out is $4 million. That's the face amount of the bond times the stated rate times the 6/12 or half of a year. That much we know. That's what's stated on the bond certificate. We determined that earlier. We're going to make $4 million interest payments every 6 months for 10 years. Interest expense is going to be a little bit more than $4 million in this case, because remember, we're paying 10%. The cash outflow is based on 10% of face value, but $4 million interest payment on a $70 million loan. Remember, we only got the use of just under $71 million of cash. That means that our effective interest is going to be more than the $4 million or more than the 10%. So we need to make sure that we understand how to determine the amount of interest expense. Interest expense is going to be computed by taking the book value of the bond, whatever book value exists, that's bonds payable minus any discount or bonds payable plus any premium, but the book value of the bond multiplied by the effective rate of interest, which is 12%, multiplied by the portion of a year for which this interest expense applies, which in this case is again half a year. So the present value, I already know that the book value of the bond right now is $70,824,000, right? I can take $80 million minus $9,175,000, and I get the $70,824,000. So I take and multiply that by 12%, so multiply it by 12%, and then multiply that by half a year, or 6/12. And I can determine that my interest expense is $4,249,444. So here's the key. Interest expense is based on the book value of the bond multiplied by the market rate of interest multiplied by half a year, or the appropriate portion of a year. So that gives me my debit to interest expense. The difference between what I'm paying out in cash and the amount of interest expense that I'm recognizing is going to go to the discount on bonds payable account. Notice here what's going to happen is I'm going to reduce my discount on bonds payable. Discount on bonds payable is again one of those contra liability accounts. It's basically a holding account where I temporarily hold some interest expense, and then I allocate some of that every 6 months to the income statement. So what happens on June 30th is my interest expense consists of the $4 million of cash payment plus the amortization of the bond discount. And so I end up with this $4.2 million worth of interest expense. Notice also that the balance in my discount on bonds payable account is going to decline. It started out with $9,175,000 some odd dollar debit, and now I'm crediting that account or reducing that account by almost $250,000. That also means that the book value of the bond is increasing, right? My subtraction of discount is getting smaller, and therefore the book value of the bond is going to increase over time. What happens with a bond that's issued at a discount is the book value starts out at whatever discounted amount it initially starts out at, in this case $70.8 million. This amortization process will slowly eliminate this discount on bonds payable so that the book value will slowly increase towards face value, $80 million. In the case of a premium, the exact opposite would actually occur. The book value would start out at more than $80 million, and I would be amortizing a premium, and the debits and credits would be reversed here. And so as I amortize the premium, once again, the value of that account would be declining, and therefore the book value would be working its way again towards $80 million. Since it started out at more than $80 million, it would be working downward towards $80 million. Whether a bond is issued at a discount or a premium, the book value is always going to work toward face value. Whether it starts out above face value initially or at a discount below face value, like in this example, in either case, the amortization process is always going to force the book value closer and closer to that $80 million. Right now, we have another journal entry that we have to deal with here in 2013, and that is the December 31st, 2013 journal entry. Remember, interest is paid twice per year. So let's run through the calculations that we need in order to do that. So December 31st, once again, the credit to cash is going to be $4 million. The credit to cash is always going to be $4 million. Every 6 months, we're paying $4 million in interest expense, or paying $4 million of cash. The question is, how much is our interest expense? And what we need to do is we need to recognize, remember, that we started out with a $70,824,000 balance. We actually increased it as a result of our first interest payment, we increased it by $249,444. So I started out with a $70,824,063 balance, and now I've added, by reducing the discount on bonds payable, I've added $249,444. So as of June 30th, I didn't prepare a balance sheet, but as of June 30th, the balance, the net balance in my bond payable is $71 million and some odd dollars. That's the book value. That's the face value minus the current balance in the discount on bonds payable account. So once again, in order to determine interest expense, I take that book value of the bond multiplied by the market yield, which is 12%, multiplied by half of a year, or 6/12 of a year. And that tells me that my interest expense for December 31st is $4,264,410. Notice here, the cash amount paid out is always going to be the same. That's the $4 million every 6 months. The effective interest method causes the interest expense every 6 months to change. And in fact, in this particular case, the interest expense is going to be going up slightly every 6-month period of time. So as we amortize more and more of the discount balance gets smaller and smaller. And so the net book value of the bond continues to increase towards that $80 million. And that means that interest expense is going to be increasing. Okay, so now the last step here in dealing with the issue of a bond is the disclosure of the bond. And so the disclosure issues, what happens on the balance sheet? Well, we're going to show bonds payable with a net amount of $71,337,917. Now, you can ask, where did that come from? We can go back to the calculator here. So remember that I started out, I'll start from the very beginning. The face value is $80 million minus the $9,175,937 discount. So my book value started out at $70 million. Then I have increased it by $249,000. Then I increased it by $264,000. So I can add those amounts in. 264, 410. And so now, as of December 31st, my book value is $71,337,917. So that's where my balance sheet disclosure comes from. Now, disclosure is beyond just what happens on the face of the balance sheet. The other thing that I would have to disclose, or would be part of the financial statements, is the amount of interest expense that was recognized during the year. And the amount of interest expense is just the total amount that I debited to interest expense during the year. So we'll go back to the journal entries. So I have a debit to interest expense for this $4.2 million, and then another debit to interest expense for almost $4.3 million. I just add up the debits to my interest expense, and that tells me the amount of bond interest expense that would be included on the income statement. Finally, there would have to be a footnote, particularly in the year in which the bonds were issued. And so in the year in which the bonds were issued, the footnote to the financial statements would just include a statement as to what exactly happened. And what happened was the description of the problem. The company issued 10% bonds on January 1st with a face value of $80 million, etc., etc., etc. It's just a repeat of the problem itself. Okay, so that is the disclosure issues related to this bond. So in the first video, we talked about measurement, determining the present value of the future cash flows. In this video, we've explored the recognition, how to go about recording the journal entries, and most importantly, how to go about determining interest expense as well as the book value of the bond. And now we've also worked on the disclosure issues, how the bond would be presented on the balance sheet, how it would be presented on the income statement, and then finally, don't forget that the footnotes are required as well.